Alright, everybody, welcome back to another video here on the Financial Friends YouTube channel. Thank you for joining me. If you are new to Financial Friends and you're not sure what exactly it is, Financial Friends is a community of people who have joined the friend group and love to learn and talk about business, investing, and finance. So if that is you, go ahead and hit that subscribe button. Join the friend group. We'd love to have you. If you're excited for this video or you just want to support the channel, a quick free thumbs up on the video really does help. It pushes the video to more people, helps the friend group grow, and helps us all learn more from new perspectives from new people. So without further ado, let's go ahead and talk about the reason why you clicked on this video, which is learning about active versus passive investing. What is it? Why do we care? What types of investments are included? And what are the pros and cons to each? So first things first, this is a little bit more geared towards newer investors. The reason why you should care about this is because you should kind of be, and I put this in quotes, identifying with one of these categories, either an active investor or a passive investor. Now, the reason why is it kind of helps you to move in one direction. And this sounds dumb, but I put a microwave and an oven on here. And it's kind of like if you were to try and microwave your food, you're going to try and do it fast, quickly, get it done. Or if you're going to put your food in the oven, let it preheat, let it take time, and let it cook. Now, obviously, the exception to this rule would be you could put something in both the microwave and the oven and do half and half. And the same exact thing goes for passive and active investing. You can use both passive and active strategies while you invest. But again, to move in one motion forward, it kind of helps if you identify with one of these. But again, the theme will consistently come up that you can do both and is not mutually exclusive. So at the most basic level, active versus passive investing is whether or not you want to be hands-on or hands-off. And that's really what it comes down to. It's very simple. You either want to be an active trader, actively looking at, researching, and finding new stocks to invest in and the best times to do so, or you just don't. You want to set it, forget it, and move on. And I think a lot of people kind of identify with that passive route, but the one that's more popularized, more mainstream in what you think of when you think of investing is the active strategy. So there are lots of different types of investments out there, not just these. We're talking more stock market related, but there can be both passive and active, investments in both cryptocurrency, real estate, obviously the stock market, all different types of things. But in general, we have these three specific types of investments within the stock market. The broad market index or ETF, this is things like your S&P 500, Dow Jones, those types of things that track a whole big section, right, of stocks, whether it's the top 500 companies via the S&P 500, the largest tech companies, not including financials, with the NASDAQ 100, whether it's the largest companies, the most popular and well-known companies like within the Dow Jones. Video on that linked somewhere up here if you want a little more clarification between those three. But a broad market index fund or ETF is going to be more of a passive strategy, a more set it and forget it style strategy. Now you also have your sector specific ETFs. These are things that track the, agriculture or technology or financials or industrials or healthcare sectors. And these can be both passive and active investments. A lot of times active investors will use these on market swings or the way that the business cycle works. During specific inflationary or deflationary times, a sector might do better or worse. And you can also passively invest in a sector, maybe if you believe in it and its growth over the long term, like healthcare, technology, things like that. And individual stocks can be utilized in both passive and active strategies. If you think a solid dividend stock or dividend company is going to be around for a very, very long time and you want to passively invest in dollar cost average, you can do that. If you think that with a growth company like Amazon, Apple, Google, Facebook, Tesla, whatever it is, you can passively invest in them as well. And with active traders, they might buy that stock and then trade that stock and then sell that stock and then buy options on that stock. And they might do all different types of things with it versus a passive investor is a little more buy, a little more hold. So between the two, right, I just kind of spoke to this a little bit. You have your active and your passive, and they have different type of actions and emotions within the market. Active investors like to time the market. They like to figure out when the best and most optimal time to buy is, which in this small little graph down here, for explanation purposes, is going to be this bottom part or this bottom part right here, right? You want to buy when stocks are low and you want to sell when stocks are high in value. But they also will invest based on sentiment or emotions. Is the stock market upset and angry because we found out that inflation's high and that there are going to be interest rate hikes? Do we think that GameStop is on a move and we want to get in and get out quickly? Do we think that CVS in the healthcare sector is doing really, really well today because of news that just broke? And we want to invest in that company and then sell it by the end of the day or a week from now after the stock has finished appreciating. These are hard things to tell, and that's why we'll speak on it a little later. Active investing is more difficult than passive investing. On the passive side, you buy here and down low and up high, and there's no emotion to it. It's almost robotic. It's timing. It's on a day, on a specific time, $50 goes into the market for you, and you don't really have to think about it. Now, this is going to speak a little bit more to the passive versus active strategy in regard to performance, because generally, as you can see by this graph, and I made this and posted it on Instagram, so if you're interested in following, whether it be on TikTok, Instagram, or Twitter, at FinFriendsYT, if you want to go ahead and check that out, you can see them always behind me here, along with my public account. But this graph here shows the 3-year, 10-year, and 20-year percentage of companies that are underperforming this comparison index. So this is a little bit deeper of an explanation. Let me move myself out of here. Higher average returns is a pro of passive investing. In general, either 69.71% of the time, 76.31%, or 94% of the time in those respective circumstances, passive investing has outperformed their active investing counterparts. These are pretty substantial numbers, none of them being below 50%, which is extremely impressive. That a passive investment, accepting and getting average market returns over a 3 to 10 or 20 year period, is actually better than trying to actively work towards being higher than your counterpart, than your passive counterpart. So I use the term here, attempting to overperform can often leave you underperforming. Chasing gains can often leave you with less of them. So I wanted to mention this here. I wanted to check this Forbes website. I think this is a fantastic website that kind of underlines some of the main pros and cons of passive versus active investing, and which you should kind of pick. Now, this is the Forbes website, like I mentioned. The link will be down below if you want to check it out for yourself. I highly recommend that you do so, do a little bit extra research. But here you can see some of the pros to that active investing strategy. You have flexibility when the markets are volatile. You can be in, you can be out. You can be in a defensive or an aggressive position in bonds, in stocks, in crypto, in real estate, in anything, right? You have that flexibility. And by real estate, in this specific instance, I mean real estate trusts, not actively buying homes like trading on the stock market. You have options, literally using the options market, using contracts, puts, all that stuff that I'm really not into. You can use those for higher leverage or to hedge against positions, meaning if you think something's going to go up, you can make sure you have a position that will benefit in case it goes down, right? You have all these options, and then you can really manage the way that your taxes are affected. You can, sell at losses to offset gains. There's a lot of different things that you can do when you are active investing. But all of it takes a lot more work. And they talk here about some of the disadvantages being you do have higher fees. Oftentimes, if you're investing in those sector-specific ETFs or ETFs that are actively managed by another human being, you're going to have a little bit higher of an expense ratio that you have to pay them because they're actively making moves for you. You do have increased risk. Most of the time, that is because you are exposing yourself to individual companies and you're no longer staying in a broadly diversified ETF or index fund. So your risk is more concentrated in the success of individual companies. Your trend exposure. A lot of times you can try and ride waves, and that can be of benefit to you, but it can also be a failure or a loss or cause you to lose money. If you invested in Peloton, they use this example at $145. that stock is now in the low 50s, and if you thought it was a good long-term hold or you wanted to actively trade and get in and out of it, well, hasn't been so good for you thus far. Now, the advantages of passive investing include the opposite of many of the other ones, that being a decreased risk and lower costs. Not going to dive too much into those. Increased transparency. This basically means when you're holding a fund or an ETF, whatever it might be, you pretty much know exactly what's going to be inside of that fund. There's no surprises, no random companies, no random buys, no random sells. It is what the index says it is. It's the top 500 companies, it's the top tech companies, whatever it might be. And then, again, we already spoke to the higher average returns, so I'm not going to expand much there, but the disadvantages are obviously no exit strategy. You're not able to navigate yourself through things, and oftentimes you just continue to dollar cost average, which if that's the strategy you've determined is best for you, it personally is for me, then that's what you do. You also have the one thing that a lot of people say, oh, well, that's boring. It's boring to do that. Well, we've talked about it before. It's been up on this board behind me. It was the topic of the last video and a topic of a video way back when. Boring is often better. It often performs better, does better, and makes you more money. Just saying. So again, that was a little bit more of the pros and cons. Check out that website linked down below. I also did want to quickly mention that in regards to these types of investments here, these are not the only types of investments. These are not the only types of investors that invest, right? Not everyone's going to be in these positions, and everyone has different goals. You have a lot of people that are day trading, using options, planning for retirement, trying to buy value positions, right? Stocks that are valued way down low and should be way up high. You have people that invest in dividends like myself, and people who are invested in growth companies. So those kind of sway from being passive to active. But again, your main thing, if you don't take away anything from this video, active means you're hands-on and passive means you're hands-off. You really want to determine what is going to be best for you as an investor and what aligns best with your goals. Is your goal to plan for retirement, buy value stocks, buy dividend companies, whatever it might be? That is for you to determine. If you have any questions, leave them down below. I would love to help and chat with you. None of this was financial advice, but being a part of the friend group means you have access to other friends. So if you have a question, leave it down below. Someone else will get back to you. I know I will get back to you, and we can all learn and grow together. Thank you so much for watching this video. Like I said, I hope you learned something new. But if you didn't or you have a question, leave that down below. If you did learn something new and you want to support the channel, leave a thumbs up, subscribe, join the friend group, and I will see you all in the next one. Take care.